And let's talk about the debt being used on the syndications and as well as, the ones that are in the fund. Is that mostly fixed? Is that mostly variable? How much is variable? Where are you getting the debt from? Let's talk a little bit about that leverage risk.
So we're not quite preferred with Fannie and Freddie, but we're close. Meaning, just we've done so much business with them. We are primarily a fixed interest rate shop. There were some deals we did in 22 and 21 where at the time it made sense to go floating with rate caps. And so I think we have 5 projects that have floating rate debt with caps. And so that became interesting as they hit their caps and went, and you reset that market for escrows, and it impacts cash flows in the short run. But once that interest rates start to come back down, all those escrows get released, then your cash flows increase, and you sort of get to play catch up. Grays Harbor, the current deal, is fixed rate debt. Bridgehead Trade Winds is floating rate debt, but those costs are actually already starting to come down. So I think you're going to see that floating rate debt, you'll actually see some of that come back in. It'll just depend on when the Fed gets to a low enough level. But for the most part, we're a fixed shop. And for the most part, we're getting 10 years of term. Anytime we do 5, we're having an expectation of getting incremental 5 at the tail end of that. We've got a MetLife deal. We've got another deal with Fannie. That's a 5-year deal, but most of them are 7s to 10s.
And how much leverage are you putting on most of the projects?
60 to 65. We're not a high leverage shop. We don't do bridge lending. We don't do mezz debt. We're very boring about it. We don't want to create risk from the leverage perspective. And your 3 biggest risks are the manager of the market and your debt structure and reserves. And so you want to have moderate leverage to get increased returns. We have the right reserves for your approach. You want to have a manager that has success doing what you want to do in the best markets you can. If you kind of do all those things, you put the odds of success on your side. Mix with one of those variables and your risk goes up.
Can you talk about the most challenging property that you're dealing with right now?
That would probably be Heights of City View in Fort Worth. That deal was a floating rate project that just dealt with, it was bought at a level pretty much at the low and had to ride all of the increase. So it's performing operationally, but because of its financing, it's just not distributing right now, which is atypical. Prior to 22, I think we had a 90% distribution rate. We only had 1 or 2 properties that weren't distributing in a given time. We have another Fort Worth property, Depot, which you're in. That one is there's so much supply coming in that market that until they stop generating new supply, it's just going to slightly trail the market until that slows down. But Go ahead.
Yeah, I think the cash flow on that one's been below pro forma. What's typical on the pro forma cash flows? Are most of them at pro forma, half above, half below? What's happened in the last few years?
I would say prior to the interest rate increase, we were probably at 80%, let's call it within 1% of pro forma or above. So, and that window is going to be just noise. And then you'd have 20% that would be below. I think with the rate cap market, when interest rates went up, then we probably went to 1/3 below, and then 1/3 just a little bit below pro forma, and then 1/3 at. So it just kind of shifted down a little bit, and primarily driven by the ones that had floating rate debt.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.